Good morning and welcome to another edition of the Main Management Weekly Market Note. As usual, I'm Alex Varner, head of research here alongside
James Maxwell, SVP of Research.
Let's get into it. As standard, kind of our offerings for the four ETFs we have. Our performance was pretty mixed on the week. Sectors were basically split, half up, half down. The leader was materials and financials, or were materials and financials up 2.4, and the laggard was tech down 2. On the broader index side, you saw commodities fall 3% in the week, while small caps led the way up 1 spot too. And basically everything is positive year to date from the sector basis. Real estate is now the laggard at just 0 spot 2, as Staples has moved a little bit higher past it. And for the year to date for the broad indices, Europe still leads the way up 34%, and emerging markets at 30, basically double the S&P, which is right at 16. So still continuing to see good performance from the international space. On the recession dashboard, not a ton changed. This week is a much bigger data week. We get both non-farm payrolls and CPI, which have been delayed. So those will be on front and center this week. But last week, basically the big news, as you probably heard, the Fed cut rates by 25 basis points. So we've now had 75 basis points worth of cuts this year. The target rate is at 3.5 to 3.75, which is back to where it was back in November of 22. Two members dissented in favor of no change. They didn't want any cuts, while another one wanted a 50 basis point cut. Powell kind of said in the presser they think they're well positioned, so we might get a pause here in January. A little bit more kind of wait and see. I think the summary of economic projections was positive with the revisions, in that you saw 2026 GDP revised higher to 2.3 from 1.8, and core PCE down to 2.5 from 2.6. So you have better growth expectations, lower inflation forecast. Unemployment was unchanged at 4.4. I think they think it'll tick up to 4.5 maybe this week, but again, just kind of moderating around that level clearly.
One of my takeaways from the meeting last week, I think a lot of the fear out there was that they would cut and it would be overly hawkish, saying no more cuts at all, or very, very kind of aggressive on keeping policy tighter rather than looser. The takeaway I would have is that wasn't as bad as feared. This chart looks at it well, which is obviously the markets liked it, the equity markets liked it, where they kind of said, yeah, we might pause, but leaving the door open based on how the data comes in. And then you also saw that with the sector performance, like under the covers, like small caps leading, materials, financials, kind of the all cyclical or like economically sensitive sectors doing well, which makes sense given kind of less than feared on the hawkish side.
Yeah, and I think also you're seeing, there's one more cut forecasted in both 26 and 27, so cumulative, so 25 bips at each of those. I think we're likely to see a kind of broader range of views on the appropriate path as you go forward, because given they are well positioned, it kind of affords people the ability to have an opinion one way or the other, because you're not like, oh, the labor market is clearly deteriorating, so we have to cut. So it kind of is it's a luxury almost that they have, where they can kind of have differing views and discuss. But I think the point is that it's a little bit less clear as to kind of the timing where things will kind of play out. I've seen some pieces from bigger banks that think there are 50 bips of cuts coming in 2026. They're forecasting 2 cuts. But I think January is probably going to be a wait and see, unless things really kind of deteriorate in the data we get between now and then. But I think, under the covers on that SEP, the upward revision and growth forecast is driven by kind of anticipated productivity gains. The downward revision in inflation was definitely more optimistic than people expected. But I think they think tariffs that impact is kind of working its way through. And you've clearly seen that in core PCE for goods versus services, where services are continuing to decelerate, disinflationary, goods are accelerating. So you kind of have two sides to that, level, which dictates the headline reading.
And they offset each other largely.
Exactly.
The goods and services, kind of goods increasing, services decreasing, net kind of neutral, or maybe slightly up.
Yeah. And then also something that we noted was Powell kind of said maybe payrolls have been overstated by 50K, by 60K on average from like May to September. And that implies a negative 20,000 jobs rate per month over the last several months. That's kind of interesting because he's been in office for several years
Yeah.
and has never questioned the
He
BLS
never
data.
commented on
And
that.
all of a
Yeah.
sudden, to throw kind of a question in on like, oh, we're not sure if this is
Yeah.
accurate or not, is an interesting dynamic.
Well, I mean, you've seen those big, 800,000, 900,000 revisions, I think back to back past
Yeah.
couple of years. It's like obviously puts a question on going forward. You'd probably expect those revisions to continue just due to the nature of the data collection.
Yeah.
But that's certainly, I mean, that's one of the biggest talking points I saw of like, hey, he recognizes that the labor market's not as strong as the headline numbers make it
Yeah,
appear.
and you look at the ADP figure, like the small businesses are shedding jobs, like that clearly shows some directionality, even if
Yep,
the exact number isn't right on.
exactly.
Um, switching gears a little bit, so trade balance has been more in picture the
Mm.
last year than we anticipated. But basically, the deficit narrowed to negative 52.8 billion in September. That's the lowest since June of 2020, and was pretty, more narrower than forecast for a minus 63 billion figure. Basically, exports jumped to 289 billion. That's their second highest dollar level on record. Imports ticked up a bit, but exports were up 3% month over month. That's shown on the right there. That's the biggest monthly increase since April of 22. Imports are up a more muted 0.6, but they're interesting. Their 6-month average has fallen to minus 3.1, which is the most negative since June of 2020. Year over year, exports are up 5.7, imports are down 3.7, which is the most negative since August of 23. And I think if you look at that chart on the left, that imports figure is probably going to get a little bit worse given we're going into the tariff front running that occurred in February, March, and April of last year. So that's kind of like a comparison
Hmm.
issue, not necessarily a actual level issue.
Yep.
On the goods trade, so goods are basically 82% of trade relative to services. Goods exports were up 4.9% month over month, also at the second highest dollar level ever, and are up 6.9% year over year. Goods imports also ticked up, but are now down basically 6%. That's the most negative since June of 23. And then, kind of interestingly, as a share of total trade, goods imports have to come in, and those are the biggest kind of line item when you have goods imports and exports and services imports and exports. But goods imports are now down to 42.2% of total trade. That's their smallest share since July of 1992,
Mm.
basically when we started collecting this data. And then goods exports are the reason that for that they took share from all other categories, rising to almost 30%. And services imports and exports gave up a little bit of share, but kind of have been grinding
Hmm.
steadily higher as they've gained share over the last couple of years.
Do you read that as basically the tariffs doing what they are trying to do, which is narrow that trade deficit?
I think so. I
Yeah.
mean, again, one reading doesn't make but if you go
Yeah.
back real quick, that deficit it spiked, it blew out, and
Yep.
now it's come back in considerably.
Yeah.
So
Probably part of that was the front running and then
yeah,
people, not needing the goods that they pre-ordered.
yeah,
Um,
yeah, that front running really blew that, kind of distorted that number. But now seeing it kind of, if you kind of cut off that second spike on the right
yep.
there, it's starting to come back in, which
Yep.
was the idea behind the tariffs in the first place. We also got the job openings and labor turnover survey this week. That was September and October. So interestingly, the JOLTS came out with September and October. The non-farm payrolls that are out this week are coming out with November, but basically won't do October. But anyways, openings ticked up to 7.67 million, and then September was up 7.66. Both of those were above expectations for 7.2 million. But hires declined to 5.15. That 218,000 month over month drop in hires is the biggest monthly decline since June of 2024. Quits also fell to 2.94 million. That's the lowest since August of
Wow.
2020.
Yeah.
That's a little worrisome because that's a kind of a labor market confidence indicator where
Mhm.
people are more likely to quit if they think they find a job somewhere else. So seeing that deterioration in quits kind of implies that people aren't maybe as certain of their ability to find another job. And then, layoffs kind of ticked up. They're at the most since Jan of 23, but they've just been kind of grinding higher and still are basically back in line with levels pre-pandemic.
I know for quits too, one thing that you can watch there is that labor. It's kind of this labor market confidence. How confident are people they're going to find another job if they leave? It also tracks pretty closely with wage growth because if the employee is less confident, they're not going to be asking for a raise or they're not
Mhm.
going to be changing jobs and getting that raise. Overall, that kind of dampens wage growth, which is a good thing for lower inflation because oftentimes wage growth can feed into higher inflation with higher wage growth.
Yeah, because producers or employers will pass
Yep.
those increased wage costs on to
Yep.
customers in the form of the prices of their goods.
Yep.
So looking at the kind of the ratio of quits or layoffs to quits, that's on the left. So we're at the highest ratio since August of 2020 at 0.6 layoffs per quit. So while the kind of quits continue to outpace them on an absolute basis, as we mentioned, you're seeing fewer quits. And then on the right, you show this kind of percent of total separation. So there's quits and there's layoffs, and then there's like a third category that's just kind of other separations, be it something like maternity leave or injury or that sort of thing. But basically, firms are clearly reporting more layoffs, which are up to 36.7% of total separations. That's the highest since November of 2020, and kind of still, it's been grinding higher. But it's not even quite back at the median yet. So the point being is it's like this kind of swings up and below and up and below. And so we'll see if this, it'll be concerning if it kind of breaks through that median and continues to move higher. But again, we don't have the foresight to see what's going to happen. On the Small Business Optimism Index, the NFIB came out with their reading, and it inched up to 99.0, above forecast for a 98.4 reading, the best in 3 months. Interestingly, though, kind of despite the increase in the headline number, the kind of firms identifying the next 3 months as a good time to expand were unchanged at 13%. And the outlook for general business conditions on net over the next 6 months fell to plus 15%. That's the lowest since October of 24. So kind of some mixed readings in this. That sentiment number is kind of right on its long-term median. Businesses got real optimistic last year after the election results, but have kind of tempered a little bit here, but still, kind of chugging along, I guess. The sales picture, you got some kind of contradiction here between the sales outlook and the capital spending outlook, where the sales outlook improved. Next 3 months expecting, higher versus lower is a plus 15%. And then that's the best since Jan of 25. Actual sales changes versus the prior 3 months, they're still net negative at negative 9%, but that's up from minus 13 in October. So you'd like to see that kind of, at least improving marginally. However, the CapEx response has deteriorated. Firms reporting spending CapEx in the last 6 months fell to just 52%. And CapEx plans for the next 3 to 6 months dipped to 20, which is the lowest since April of 25. So I think hopefully what you see is this sales picture continues to improve. They continue to see better sales, and then that can kind of feed back into maybe getting some optimism back towards capital spending. But it's not hard to kind of intuit this, but businesses are going to kind of pull their head in, so to speak, on spending. If things are uncertain, they're just going to be like, we're going to take a pause on any major outlay here and wait and see what happens over the next couple of months. So kind of in summary, Fed cut rates by 25 bips as expected. The summary of economic projections shows that growth forecasts improved while inflation expectations lessened. Right now, we're kind of, one additional cut at some point in 2026. The timing is TBD as the data comes out. The trade deficit narrowed to minus 52, so about $8 billion. That's the lowest since June of 2020, as tariffs continue to kind of make their presence felt. The JOLTS figures kind of ongoing moderation, nothing huge there. We get non-farm payrolls this week, so that'll be a kind of more timely indicator, because JOLTS is, even in the best of times, JOLTS is always like a month behind non-farm payrolls. And then that small business optimism index was kind of mixed as the headline improved while the 6-month outlook declined. Sales improving, CapEx not. So kind of on the margin there, just signs of continuing kind of plodding ahead, I guess. And then, as we said, this week we get non-farm payrolls and retail sales and CPI, as well as existing home sales on Friday. So it's a big data week as we head into kind of this is the last full week of the year, because we have Christmas and then New Year's with markets closed. So kind of a big data week as we head into the year. But hope everybody is getting into it. And thank you for joining us again. We'll talk to you soon.
All right, thank you.